Okay, so let's say you're a senior in high school and you're thinking about college, scholarships and stuff.
Yeah.
Or maybe you're, starting to get job offers and you're looking at different like bonuses or how the payment is structured.
Right.
All very exciting things to think about. But
For sure.
today we're going to deep dive into something that can help make sense of all that.
Exactly.
It might sound a little intimidating at first, but trust me, it's super relevant to these kinds of decisions.
It really is. And understanding how it all works can give you a huge advantage.
All right, so we're diving into the world of annuities.
Annuities.
Yeah, now before you tune out thinking this is some boring financial jargon, hear me out.
Uh-huh.
Think of an annuity as simply a series of equal payments that happen at regular intervals.
Okay.
It's like getting your allowance every week, same amount every time.
Makes sense.
Or like paying for your streaming service, monthly subscription.
Right. The consistency is key.
Exactly. And the really cool part is that these regular payments can be structured in a couple of different ways, and knowing the difference can make a big impact on your financial choices.
Absolutely.
So we've got some great resources here that break down two main types.
Yeah.
Ordinary annuities and annuities due.
Got it.
And our mission today is to make sure you understand exactly what they are, what makes them different, and why the timing of a payment can actually matter more than you might think.
It's true. Sometimes the smallest details can have a big impact.
Totally. By the end of this, you'll be looking at how and when you receive money in a whole new way.
I like it. Let's break it down.
So let's start with defining what an ordinary annuity actually is.
Okay, sounds good.
So an ordinary annuity, sometimes called an annuity immediate, is all about payments that happen at the end of each period.
At the end.
Yep. Think of it like getting the benefit first and then making the payment.
Okay, I'm with you.
Our sources have some really clear examples that you can probably relate to.
Like what?
Well, think about mortgage payments, right? You live in the house for the whole month, and then at the end of that month, you send in your mortgage payment.
Right, benefit first, then payment.
Exactly same idea with like bond interest payments.
Mm-hmm.
You hold the bond for a certain amount of time, and then that interest payment shows up at the end of that period.
Okay, that makes sense.
Or loan repayments, you've had the borrowed money, and the
Right.
payment is due at the end of like a set time frame.
Got it.
Even when companies give out dividends on their stock, it usually happens after a certain period has passed.
So the key takeaway here is,
The key is you usually get that service or benefit before you actually make the payment.
I see, that's a good way to remember it.
All right, now let's shift gears and talk about annuities due.
Annuities due.
Yeah, what's the main difference there?
Well, with annuities due, those payments happen at the beginning of each period.
At the beginning?
Exactly. So you pay first, and then you get the benefit or service for that whole time period.
Okay, I see the distinction.
Our sources give us some really relatable examples for this one, too.
Oh, yeah, like what?
Well, rent is a classic example. You pay your rent at the beginning of the month.
Right, to live there for that whole month.
Exactly. Payment first, then benefit.
And insurance premiums too, right?
Absolutely.
You pay at the start of your coverage, whether it's for your phone, your car, or even future health insurance.
Right. You're paying for the protection before you actually need it.
Exactly. And car lease payments often work the same way. You make that payment at the beginning of the period you'll be driving the car.
So it's all about that upfront payment.
Yep. Payment comes before you fully receive the benefit.
Makes sense.
Okay, so the big difference here really boils down to timing.
Timing.
Ordinary annuity payment at the end, annuity due payment at the beginning. But here's the million-dollar question.
Uh-huh. Literally, in some cases.
Why does this little difference in when you pay actually matter in the long run?
That's where it gets really interesting.
Right.
It all comes down to something called the present value and the future value of these annuities.
Present value and future value.
Yep. Let's focus on present value first.
Okay, present value.
Our sources tell us that the present value of an annuity due is actually higher than an ordinary annuity.
Higher. Why is that?
It's all about the time value of money.
Time value of money?
Yep. Imagine someone offered you $100 today or $100 a year from now.
I'd probably take the $100 today.
Most people would because you could use it right now, maybe even invest it and earn a little extra.
Right, money today is worth more than money tomorrow.
Exactly. And present value is all about figuring out what a future stream of payments is worth to you in today's dollars.
So because you get those annuity due payments earlier,
Exactly.
it has more time to potentially grow or be used.
It's like a head start in the money race.
By that analogy. Okay, so what about future value? How does the timing affect how much money you might end up with at the end of the annuity term?
Well, the future value of an annuity due is also higher than an ordinary annuity.
Interesting. So getting those payments earlier seems to be better no matter how you look at it.
From a purely financial standpoint, you got it.
Okay, so we've got present value and future value, but our sources also give us a formula that connects the two for these types of annuities.
Right. The formula is this.
Present value of an annuity due equals the present value of an ordinary annuity multiplied by 1 plus I, where I represents the interest rate per period.
You got it.
Okay, so basically, to get the present value of an annuity due, you take the present value of an ordinary annuity and adjust it upwards to account for that extra potential growth because the money comes in sooner.
Precisely. It's a direct mathematical way to see the advantage of that early payment.
Okay, let's make this even more real with some actual examples.
Yeah.
Our sources talk about winning a $1 million lottery jackpot.
Oh, wow.
Yeah, pretty exciting, right? And there are actually 3 ways the payout could happen.
Okay, I'm listening.
The first option is a lump sum payment of $650,000 right away.
Okay, straightforward.
The second option is an ordinary annuity that pays $50,000 every year for 25 years.
Okay.
But that first payment doesn't come until the end of the first year.
So a year from now.
Exactly.
Yeah.
Then the third option is an annuity due, which also pays $50,000 per year for 25 years.
Okay.
But with this one, you get that first $50,000 right away.
Oh, interesting.
Yeah, and for both of the annuity options, there's a discount rate of 7%.
Okay, and just to clarify that discount rate is basically the rate we use to figure out what those future payments are worth in today's money?
Exactly. It takes into account the potential to earn 7% on any money you have right now.
Makes sense.
Okay, so the first thing our sources do is figure out the present value of that ordinary annuity, the one where you get the first $50,000 at the end of the first year.
Right, so we're using that present value of an ordinary annuity formula.
Exactly.
So A equals P times 1 minus 1 plus rate to the power of negative n, all divided by rate.
And in this scenario, P is our regular payment amount, which is $50,000.
Right. The rate is our discount rate, which is 7% or 0.07.
And N is the number of payments, which is 25 years.
Yep, 25 years of payments.
So plugging those numbers in, we get PV equals 50,000 times 1 minus 1 plus 0.07 to the power of negative 25, all divided by 0.07.
All right, let me calculate that.
What does that give us?
Okay, so according to our sources, that works out to about $582,679.16.
So even though you'd eventually get a total of $1,250,000 from that ordinary annuity.
$50,000 per year for 25 years.
Right. Its present value is actually only about $582,679.
Yep, that's the power of time value of money.
Okay, so compared to that lump sum of $650,000.
In this case, taking the lump sum is actually better.
It gives you more value today than the ordinary annuity.
Exactly.
But now let's look at how that annuity due stacks up. Remember, you get that first $50,000 payment right away.
And we can use that simpler formula to calculate the present value.
Right. PV of an annuity due equals PV of an ordinary annuity times 1 plus the rate.
Exactly. So we take our $582,679.16 and multiply it by 1 plus 0.07, which is 1.07.
And that gives us
A present value of approximately $623,466.70.
So let's lay out all 3 options.
Okay.
The lump sum cash is $650,000. The ordinary annuity with those end-of-year payments has a present value of about $582,679.
Right.
And the annuity due with those beginning-of-year payments has a present value of about $623,467.
So what does this tell us?
Even though you get the same total amount from both annuities, the timing of those payments makes a big difference in their present value.
Absolutely. And because you're getting the money sooner with that annuity due, it's worth more to you today, and it gets much closer to the value of that lump sum cash.
Wow, so timing really does matter.
It really does.
Okay, our sources give us another example. This time, it's a choice between getting $70,000 every year for 20 years
Right.
with a discount rate of 8.25% or taking a one-time payment of $700,000.
Interesting. So first we need to find the present value of that ordinary annuity, right?
Exactly the one where you get the first $70,000 at the end of the first year.
Back to the formula.
Yep. PV equals P times 1 minus 1 plus rate to the power of negative n, all divided by rate.
All right, so P is now $70,000. The rate is 8.25% or 0.0825, and N is 20 years.
Plug all that in.
PV equals 70,000 times 1 minus 1 plus 0.0825 to the power of negative 20, all divided by 0.0825.
And what does that give us?
Pete, that comes out to roughly $674,670.35.
So comparing that to the $700,000 lump sum,
The lump sum still wins out.
By a little bit,
At
right?
a little over $25,000.
Okay, but let's not forget about that annuity due option.
Right. What if you could get that $70,000 at the beginning of each year?
We use that PV due formula again.
PV of an annuity due equals PV of an ordinary annuity times 1 plus the rate.
So we take our $674,670.35.
And multiply it by 1 plus 0.0825, which is 1.0825.
And that gives us
A present value of around $730,035.
So in this case, if you had the option to receive the $70,000 at the beginning of each year,
It would actually be the best choice.
even better than the $700,000 lump sum,
Exactly. This really highlights how much of a difference that timing can make.
especially with larger amounts and longer time frames.
For sure.
So for everyone listening, especially as you're thinking about scholarships, loans, or even job offers, why is it so important to understand this difference between ordinary annuities and annuities due?
It's all about making informed decisions.
Right.
When you're comparing different financial options that involve these series of payments, knowing when those payments start can really change the game.
Especially over the long term.
Absolutely.
It's not just about the total amount, it's about when you actually receive or make those payments.
The timing has a value all its own.
Exactly. And being aware of that helps you really understand the true worth of different financial arrangements.
Whether it's borrowing investing or deciding how to accept a payout, understanding this concept is key.
Okay, let's wrap up our deep dive into ordinary and annuity due.
Sounds good.
The key takeaway is that ordinary annuities pay at the end of each period, while annuities do pay at the beginning, and that difference in timing directly impacts the present value and the future value.
We also covered the formulas for present value.
Right, the present value of an ordinary annuity is PV equals P times 1 minus 1 plus rate to the power of negative n, all divided by rate.
And the relationship between the present values of ordinary and due annuities is PV of an annuity due equals PV of an ordinary annuity times 1 plus I.
So here's something to think about now that you know this difference between ordinary annuities and annuities due.
What's that?
Start looking around in your own life and see where else this timing of payments might be affecting things.
Interesting.
Maybe it's how you decide to pay bills or how you think about saving.
Good point.
The point is this knowledge can help you make smarter financial decisions.
Absolutely.
So keep exploring those aha moments, and we'll catch you on our next deep dive.